Hello everyone, I'm Shana Morale with Tax Analysts. Thank you for joining us today for another episode in our weekly discussions on tax reform. Now today we are broadcasting from the Tax Foundation in Washington, D.C., and we have the distinct pleasure of speaking with Tax Foundation's very own Kyle Pomerleau, I believe,
yes,
Director of Federal Projects, and Alan Cole, Economist for Tax Foundation. And we are so pleased to have you on with us. Thank you for joining us. We really appreciate it. So to start off, let's talk about why now? Why the chatter about tax reform in 2017? We had the Camp Bill really not too long ago, and that was a very serious attempt at tax reform, but it really went nowhere politically, even among the House Republicans. So that experience really could have been viewed as discouraging to further activity on tax reform. But here we are trying it again. So I want to know what's changed.
well, I think the easiest explanation is who is in the White House. That's the first one. I think a lot of the optimism is due to the fact that, well, you see a unified government out there, and whatever they pass out of the House must go to the Senate, and then that's obviously going to pass, and that's obviously going to go to the White House and be signed immediately.
Sure.
That's the initial sense there. But I don't think tax reform is any easier than it was back when Camp put out his draft. I think that it's still a lot of the same challenges back then, a lot of the same trade-offs. So I think the chatter is all about the different political landscape, but I think the policy challenges are the same.
Okay.
Yeah.
One thing we saw from the Camp episode is that tax reform was really designed in order to be bipartisan and have some cross-partisan appeal.
Yeah.
And in doing so, it lost a lot of Republicans. But creating a tax reform that's perhaps designed around getting entirely Republican votes, that's now an avenue that's available, and it wasn't a couple of years ago.
Absolutely. All right, so in your writings and in your public speaking, both of you have expressed some sympathetic views to the House blueprint. And let's focus on the features that you guys find, appealing. So first, let's consider the cash flow tax. Why is a destination-based cash flow tax preferable in your eyes to to the more conventional origin-based corporate income tax? Like, how would that improve things?
You can go first with this one.
Yeah, sure. So one of the big things about origin-based corporation taxes is they're just a loser around the world. They've been declining almost everywhere. England is a big example of this, but there's really just every country around the world has been reducing their corporate income taxes because it's just hard to collect the revenue. It's hard to say what's in your country and what isn't. It turns out that basing corporate profits on location is actually really difficult. There are a lot of good examples of this, but if you just think about anything that involves the collaborative efforts of people from different countries, the idea of dividing those collaborative efforts and apportioning the profits to each place, it's just kind of an administrative nightmare.
It would be very complicated.
And that's one reason that rates are going down, and the other reason that rates are going down is just that there's a lot of genuine competition for investment. I don't think it's lost on other people in Europe that, for example, Ireland has a really outsized amount of legitimate investment from tech, as well as profit shifting from those same intellectual property heavy companies. So the question is kind of what should the US, who has been kind of the last mover on origin-based corporate taxes, what should the US do to reform? Because it's clear that every other country is doing that.
Yeah. And the distinct advantage of a cash flow tax is it addresses a lot of the major concerns that economists have about the corporate income tax. You have the issue of the corporate income tax falling on marginal investment, or that next investment company would make. So you'd see that investment would tend to be lower than it otherwise would be. There's this debt equity bias, and we'll probably get into that later with the cash flow tax. So the United States, again, it has the opportunity to catch up, but also going to a cash flow tax, it also has the opportunity to sort of leapfrog ahead of a lot of these countries, because if you're really talking about a tax reform that trades in the corporate tax in its entirety for an entirely new tax, whereas a lot of European countries have been slowly phasing out their corporate taxes by cutting them and at the same time raising their destination-based tax, their value-added tax to replace the revenue.
That makes sense. Okay, so under our current law, we have the related concepts of capitalization and cost recovery. So when firms invest in heavy equipment, they need to depreciate it over the useful life of the asset. Now, in contrast, the blueprint calls for immediate expensing, but it also disallows a deduction for net interest expense. So expensing provides a tax benefit to businesses, and the interest proposal does not. What are the justification for those features?
So the best reason to do expensing is that it really kind of matches up the tax revenues almost exactly with the business's actual cash flows. That's one of the reasons it's called the cash flow tax. Mm-hmm. If you think about it, if a firm expends a certain amount of money on an investment and then it gets the returns, and the tax rate just applies to the cash flows, you get a deduction for the investment as you make it, and then you get taxed on all of the returns, and that's all. It's sort of as if the government is investing in your company at book value by giving you that deduction, and then taking the returns at market value. And that's a way of raising revenue a little bit without actually changing the incentives for how the business would do things. Sure. They'll look at the cash flows and the discounted cash flow analysis, and it's still the same. It's just a little bit lower stakes because the government gives you a deduction, which lowers the cost, and then it taxes you on the return, which lowers the returns by a proportionate amount. So that's the reason to think about expensing. Mm-hmm. Now, the interest provision, that's taking away a goodie rather than giving it. Yeah. So that's likely to get more resistance. But one thing that we actually see from CBO reports, and if you just think about particular examples, the tax rate on interest finance things is often actually negative. And here's the reason for that. Think about a tax-exempt investor of some kind. Mm-hmm. Let's think about, say, a Yale or Harvard endowment. Let's think about pension funds or sure. IRAs. They don't get taxed on interest. Yeah, and foreigners is another one. They don't get taxed on their interest income. But interest deductibility is given to businesses kind of premised on the idea that there's someone receiving that interest and paying tax on the other end. But increasingly in our economy, that's not really true because we've given various tax exemptions to different kinds of investments. And the result of that is if I'm taking a deduction for interest paid and someone else isn't paying tax on interest received, just by kind of making up a borrowing arrangement, we've kind of reduced our taxable income, just made it vanish into thin air. And that's a real problem for the tax code, and it's really reducing the level of revenue that we could be getting at the rates that we have.
Absolutely.
And from a budgetary standpoint, or from the standpoint of putting a tax reform proposal together, so expensing, of course, is the goodie here. It's something that's reducing the marginal tax rate on new investment, but it also reduces federal tax revenue. We've estimated that it's probably the largest single cost in the House GOP blueprint.
Oh, wow.
At about 2.2 to 2.4 trillion over a decade by itself. Whereas getting rid of the interest expense deduction, that's the base broadener that goes along with that. And those two, I guess, they work together in a way to offset one another. So thinking about it that way, that those two pieces of the cash flow tax work pretty well together.
Okay. Yeah. Well, thank you. So separate from the cash flow tax, there's also the border adjustment tax, which has gained a lot of attention, a little bit of controversy with that. Not everyone likes the idea, including the retail sector and some very prominent members of Congress. Critics worry about inflationary pressure resulting from the treatment of imports, and despite the arguments about currency exchange rates. So what is your take on the border adjustment tax, and how confident are you that currency rates would adjust?
Yeah, so the first point, of course, is as of yet there is no such thing as a border adjustment tax, right? So what this really is a border adjustment to the cash flow tax. The simplest model of the border adjustment, in my mind, is what you're really doing is you're changing the tax base of the cash flow tax from a tax on all the goods produced in the United States, so the goods you produce here and sell here, the goods you produce here and sell overseas, to another tax base, the destination base, where you're taxing all the goods that are being sold in the United States regardless of where they're being produced. So that would be your imports, the goods coming in, but also the goods you produce here and sell here. Now the distinct advantage, just looking at the simple model, is that you're moving from the issue of an origin-based tax. Alan was talking about this. It's very difficult for countries to pinpoint where production is located when production processes are sprawled across the world in some cases.
Absolutely.
So you're moving from figuring out that to just figuring out basically one thing, which is where is the good sold at the end of the day, and that's a much easier task. And you see this looking at different types of taxes throughout the world, that avoidance issues are much more severe under corporate income taxes than they are under value-added taxes, which that's the main destination-based tax that's being used throughout the world.
Okay. Any thoughts? Okay.
Yeah, go ahead.
Okay, so we're going to talk about tariffs now. How are the economics of the proposed border adjustment different than those of a simple tariff? You kind of explained what the border adjustment is, and really at first glance the two seem very similar. But does that comparison really hold up on closer consideration? And also, are you guys a fan of tariffs in general?
No, we are not a fan of tariffs. The way to think of a tariff is it's like any differential tax, is you're placing tax on one set of goods at a rate that's different than another set of goods. And in this case, a tariff is falling on your traded goods and not falling on your domestically produced goods. So that's a distortion there. And this contrasts well with the border adjustment, that what the border adjustment does is it applies the cash flow tax to domestically produced goods and imported goods, so you have that level playing field there.
Okay.
One way I like to think about things is that you can think of a typical U.S. exporter. Boeing is our #1 exporter and has been for quite some time.
Sure.
And then a typical company that sends goods to the U.S. Let's pick Samsung is one of my favorites for that. And sort of think of them as a combined company. And a trade neutral tax would not hurt the combined effort of Boeing and Samsung to trade back and forth televisions for aircraft.
Okay.
A border adjusted tax gives as much to the U.S. exporters as it takes away from the goods that are imported in the U.S. And that makes it trade neutral. Whereas if you're just adding a tax onto what Samsung does, that would inevitably hurt actually both of them, because for a variety of reasons, mostly because they're counterparties in foreign exchange markets, we actually think of U.S. exporters and U.S. importers as very linked to each other. Sure. They actually need each other to do their business models.
Okay, interesting, thank you. So let's talk about the consumption versus capital income. There's been a lot of disagreement about who actually bears the economic burden of this tax, and whether it's progressive, whether it's regressive, relative to our current corporate income tax. So some observers argue that it taxes returns on capital investments, and in particular a category of income known as extraordinary profits. Other commenters suggest that it's actually a type of VAT, which we mentioned briefly earlier, so masquerading as a corporate tax, and that burden would then mostly fall on the retail consumers. So who would you say is correct in that argument?
I would say the short answer is that the distributional impact of this destination-based cash flow tax will be very similar to the corporate income tax. So I think that I would disagree with the contention that it moves closer to the value-added tax and it disproportionately hits U.S. labor. And the reason I say this is if you look at the structure of the destination-based cash flow tax, comparing it to the value-added taxes, you have one big deduction in there that doesn't exist under a value-added tax, and that's the deduction for labor. So under a value-added tax, you could think of it as sort of this add-on payroll tax that's in there, and that's where the tax on U.S. consumers comes from. That's where the added tax on labor comes from. Under the DBCFT, destination-based cash flow tax, you don't have that additional tax burden. So you're still talking about a tax that is falling on your returns to investment by U.S. shareholders. The difference in the distribution here with the destination-based cash flow tax, and I think we're getting down a rabbit hole in a very complicated model of this, is it's basically turning the U.S. tax code into a big traditional IRA for all U.S. investors. So U.S. shareholders here are going to face a tax burden on all of their worldwide investment, and that's slightly different than the current tax code, which is mostly an origin-based tax, where you're placing just a tax on the investment in the United States, regardless of where those shareholders may be.
Okay.
One way I like to think about this is you really need to think about the whole cycle of how people get their money and then how they spend it. If you limit yourself to only part of that, then you really kind of miss out on certain parts of the analysis. When we're thinking about consumption for a consumption tax, one fair question is, well, where did you get the money? And when we're thinking about income, one of the questions we should ask is, well, you're going to spend it on something eventually, right? Mm-hmm. So once you put those together, one of the things you could ask is, in the destination-based cash flow tax, if you want to think of it as a tax on consumption, then what do you do about the fact that it has that deduction for payroll? And one of the ways to kind of square it or think about it is you can think of it as a tax on consumption financed by pretty much everything but income earned from labor.
Okay.
And when you think of it that way, then there's a variety of categories left. You've got just money that people had before the tax system was put in place.
Sure.
That could potentially take a hit. Transfer payments, though those are usually inflation adjusted, so those probably wouldn't. But then different kinds of returns to capital income. Some returns to capital, because of the expensing at the corporate level, would be essentially tax-free. The ordinary returns to capital would. But if you had extraordinary returns in some kind of capital investment, for example, a really hot branded item where the cost to invest in it is relatively minimal, and then you get big returns out of it, that would be taxed. So there are ways that people are financing consumption other than labor here, and all of those kinds of consumption, probably would be taking a hit under a destination-based cash flow tax. But obviously labor is the number one way that people finance their consumption, so it's a huge exception. So thinking of it as a ordinary consumption tax, I think, is, there's a huge asterisk.
Yeah.
It's kind of missing the point.
Yeah, and if you look at just how much revenue this tax raises, it's not that much compared to what, say, actual 20% value-added tax would raise in the United States. I mean, that tax would be something that could almost completely replace all the revenue that the federal government is currently raising, and that's certainly not what we're talking about here. No. So it's separate from something that's a really broad consumption tax.
Okay, all right. Well, many other countries have what we call, the value-added tax, the VAT. Roughly 160 other jurisdictions, so we're kind of an outlier there. And the concept of the border adjustment is not new, it's not experimental, yet we hear that it's problematic in that it technically violates the WTO rules, the World Trade Organization. So if that's true, you would think that would give lawmakers pause. Why enact a whole new tax system if we're going to be forced to unwind it in a couple of years? What's your thinking on the whole WTO issue?
This is probably the biggest challenge that the tax faces at this point, that if you interpret the tax as being basically a value-added tax with a deduction for payroll, I think it's reasonable that the WTO would say, no, we don't like this. you could certainly engineer around a WTO concern by, instead of having a deduction for payroll, perhaps you have a credit for payroll instead, and that's a separate tax mechanism outside of what you're putting together in the first place. But I do think that those constructing the plan really need to take a close look at this one issue. I mean, out of everything, I think this is the one that would concern me the most. If
Pretty big deal, yeah.
Yeah, the way that the WTO rules were always constructed, and I'm not a lawyer, so these aren't totally forceful arguments, but they were always constructed with kind of ordinary value-added taxes in mind, and not with this deduction for payroll.
Mm-hmm.
And the big problem with that is even if you get to the point of saying that it's what they like to call an indirect tax, which is the kind that's eligible for border adjustment, and that's when it's
Sure.
kind of a tax on goods rather than on people's income.
Sure.
Even when you get there, you still have to pass the test of what they call like treatment. And what they mean is like treatment of both imported goods and domestically produced goods, and you can't discriminate between them.
Yeah.
And what lawyers for other countries are going to say is that this is not a valid tax unless on the border adjusted goods you get a deduction for foreign payroll as well. So would say, you know, things like if there are Korean workers that help make a television, there actually needs to be a deduction for their payroll too. And obviously, like that's way too complicated, and we would never do that.
Absolutely.
But you know,
outrageous.
this could make it fall apart because it's clear that the WTO rules were intended to kind of make sure that the U.S. workers and the Korean workers are treated the same way, and this tax doesn't do that right now.
Okay.
Yeah, and just and this will bug the tax lawyers out there, is this rule, I think, has been well constructed in the world of VATs, and it keeps things pretty sane. But from an economics point of view, whether it's WTO compliant doesn't necessarily mean it's trade neutral or not trade neutral. You know, although I think that the WTO may look at this and be like, no, we don't like this, I still think that the destination-based cash flow tax is trade neutral. You know, the way I think about it economically is that enacting this 20% cash flow tax is basically identical to a European country saying, you know what, I think I'm going to cut the corporate tax and the employer side payroll tax, and at the same time I'll raise the value-added tax to replace the revenue. Now, the WTO would not be upset about that,
Sure.
and no one would say that that was distortionary in terms of trade. So that I think that's a good way to think about this, whether or not you think the WTO issue is going to bring the tax down.
Okay, thank you. So many people consider the House blueprint, which we've been talking a lot about, to really be the only game in town when it comes to tax reform. And, or at least that's the case until we hear otherwise. It's as if the tax reform movement has really just put all its eggs in one basket. What is the best hope for a plan B in the event that the blueprint goes up in smoke for whatever reason? And does the Senate Finance Committee have anything to contribute here? We haven't really heard too much from them.
There are a couple of other ideas that are out there.
Okay.
One comes from a pair of tax scholars, Eric Toder and Alan Viard,
Sure.
and has kind of been adopted a little bit by Senator Mike Lee. And that's the idea to move the corporate income tax more towards a shareholder tax just by taxing the shareholders directly. You would increase taxes on capital income at the individual level, probably to the rates on ordinary income, and use that to finance a cut in the corporate income tax. And that way you are less concerned with the troubles with figuring out where origin is. Taxing people is easier. You can kind of say to a person, no, you were in our country, pay your taxes, deal with it. And it's a lot harder when there's some sort of international corporation going on, because then the question of how much were they in your country is difficult. So that still solves a lot of problems, and I think it's worth looking at. And then there's also ideas coming out of the Senate Finance Committee, Senator Orrin Hatch, and that's kind of the idea of maybe give corporations a deduction for dividends paid, but then issue a withholding tax, and in that way you could make sure that all of the shareholders, including the ones that might be tax exempt under ordinary circumstances or foreign, end up paying a portion of the, essentially the withholding tax helps you bring down the corporate income tax.
Okay.
Yeah, and there are other plans out there, but I think their political viability is much lower at this point. But we do have two proposals out there that look similar to the House GOP blueprint from a 30,000-foot level, but I think the precise taxes in there make them unworkable, at least now, and that's both Senator Cardin's tax plan and Representative Jim Renace's tax plan.
Okay.
Both have very similar features to the blueprint. They basically bring down the origin-based corporate tax to either 17% or 0 in the case of Jim Renace's plan, and they replace most of the revenue or all of the revenue with a value-added tax of around 7 to 15% depending on the proposal, and they also, to maintain progressivity in the code, reduce the income tax significantly and expand tax credits.
Interesting. All right, thank you. So finally, to close this all up, any predictions with respect to legislative timing? How likely is it that tax reform will happen this year?
So tax reform is pretty hard. It
Pretty
requires
hard.
a whole lot of pieces to get in place. If you want to include base broadening measures in that, then often the people who pay the burden of the base broadening measure are going to object.
Sure.
There will have to be a protracted debate on that. Most tax systems have administrative problems of some kind or another, maybe even all of them do. Coming up with the right legislative text to address those administrative problems to the best of your ability, that takes time as well.
Absolutely.
This is a months-long process. This isn't, so easy a kid could do it sort of thing. You can't just go in there and write your plan and say, I'm done now. It will be a while.
Yeah.
I think that was a really great answer. Thank you. All right, well, thank you both for joining us today. I think we learned a lot. I hope you guys did too, and make sure to join us next week.